On today's episode, we're going to do our normal review of mortgage interest rates on average throughout the country. We're going to take a look at the bond market, what's going on behind the interest rates, what the Fed's decision was, the impact that AI is now having on interest rates, the National Association of Realtors January existing home sales data for December of 2024, rounding out the year, a fun fact segment, and a Did You Know segment, all focused on condos. Let's get into it. Welcome to Mortgage Markets and More. I am your host, Peter D'Angelo with The Rate. I hope you're all doing well. Chock full episode today, that is for sure. Just a quick note, moving forward, I used to do a separate episode that reviews the National Association of Realtors existing home sales data, deep diving in, reflecting back on it. I think that's going to be more valuable just to hit the really high value, important points that this report provides us with monthly. So I'm going to be including that today, as well as moving forward, whatever episode is closest to the release of that information to provide it to you. So hopefully you have some more information to empower you as a real estate professional or as a prospective home buyer. Without further ado, let's get into where those interest rates are as of recording this episode, the Thursday before its release, according to Mortgage News Daily's survey of national mortgage interest rates. Starting off, our 30-year fixed-rate mortgage is averaging 7.06%. The 15-year fixed-rate mortgage is averaging 6.48%. The 30-year jumbo fixed rate, that's averaging 7.35%. The 30-year FHA mortgage is averaging 4.86%, and the 7.6 SOFR adjustable rate mortgage is averaging 6.89%. Overall, not a lot of movement, just a little bit down, and this is 2 weeks in a row. We've seen that the jumbo mortgage rate has not changed week over week over week. Let's get into the Treasury yields. What's going on in the bond market today? The 10-year Treasury is yielding 4.492%. The 5-year Treasury yield is at 4.301%. And the 2-year yield is at 4.201%. Kind of flat, a little bit less. We saw a little bit more improvement on the shorter end of the Treasury yield curve, and that is providing a little bit more relief there, as we saw in the 7.6 SOFR adjustable rate mortgage. Directly right now, I can address something that happened in the bond market this week. It's a little bit uncharacteristic, and that is that there was an impact from artificial intelligence. On Monday, news broke that in China, a new AI platform called DeepSeek had been released, and it's what they call open source, which means that anyone can crack into it and see exactly how it's built. And essentially, what this did was disrupt the AI component of the markets. So we're talking about NVIDIA, who makes the chips, OpenAI, Gemini, Google's Gemini, Anthropic, take your pick. Anything that is AI related was affected by this news because of a couple important details. DeepSeek, because of the chip embargo that the US had, DeepSeek was built in China, and the resources available were far less powerful than the types of chips that NVIDIA is creating and that are being implemented by some of the bigger AI players in the US. What that translated to is with 1/20th of the processing power and 1/20th of the energy requirements, DeepSeek was able to provide an AI platform that is comparable and rivals what ChatGPT looked like in its infancy. The implications for this then sent shockwaves through. Earlier this week, NVIDIA lost something close to 17% in their stock price because of this. And what this essentially did was create the flight to safety. We've talked about this on past episodes, but I'll reiterate. The bond market is considered a safe haven asset to invest in. So whichever timeline for investment that you're interested in, it's considered safe haven. When we see volatility in the stock market, a lot of investors will then move money from the stock market, sell off. That's where we see the price go down, because when you have high amounts of selling, the stock price goes down because of the flood of inventory of stock to purchase, and then they move their money into safe haven. When that money moves in large droves, it drives the yields down, exactly the opposite way that it works in the stock market. So when someone's selling off, there's a lot of sellers, not as many buyers. That drives down the price. On the bond market, there's a fixed amount of bonds that are available. So when they go to purchase those bonds, if there's an influx of buyers, well, now the price goes up. When the price goes up, the yield goes down because the bonds have a fixed maturity value. So that's why we have the bond market looking the way it does today, and it did provide some slight relief for mortgage rates. We also had last week the National Association of Realtors existing home sales data that had an impact on the markets. We're going to deep dive into that, so I'm going to skip ahead to probably the more important element from this week that's affecting the markets. And in the short term, not much of an effect, but as we've learned, it takes some time for the markets to digest the information. And that information was the Federal Open Market Committee's interest rate decision for the Fed's monetary policy, which was released on Wednesday. So, as expected, the Fed did not change their interest rate. They had 3 cuts last year, ending out the year with a 1/4 point cut, bringing the Fed fund rate to 4.25 to 4.5%. And everyone was expecting nothing to occur. Interest rate cuts for this year, the prospects of that are extremely low. And that was kind of reinforced with Fed Chair Jerome Powell's commentary and answering of questions by reporters after the Federal Open Market Committee meeting, which took place Tuesday to Wednesday. Breaking all of that down for you, they are staying data dependent because currently the job market and employment market in the U.S. is showing that it's stable and strong. The economy is doing well. We're going to get GDP later today when I'm recording this episode. So next week I'll report out on that. And then tomorrow, as you're listening to this episode, actually on Friday, we're going to be getting the personal consumption expenditure, which is the Fed's preferred inflation gauge. Those are likely going to have more of an impact on the markets than what the Fed had to say on Wednesday, which was really nothing more than the narrative that we all understand right now. The Fed is holding and sitting tight. They're going to continue to monitor because, really, inflation is stubbornly staying above the 2% target that the Fed is trying to manage inflation down to. That is it for where the market is right now. And I'll keep you posted next week. We're going to see how much of an effect GDP and the personal consumption expenditure, what inflation looks like from that inflation gauge next week. And we'll also have the information from how the week goes with market reaction. So I'm really excited to share that with you. For today's exploratory idea, we're going to explore the National Association of Realtors existing home sales data, which is the report furnished in January, providing the information of sales data from December of 2024 to round out the year. Kicking things off, we had a 2.2% sales increase in December to a seasonally adjusted rate of 4.24 million units sold. And that's the highest since February of 2024. It was a strong start to the year in 2024, if you recall, because inflation made its first real meaningful progress. And so everyone was starting to expect interest rates to go down, which caused interest rates to go down for a couple months. And that really stimulated purchasing in the beginning of the year. Those hopes were dashed later on as inflation stubbornly ticked up. But comparing February to December, a lot of strength there to round out the year. Year over year, sales grew by 9.3%. That's the largest annual increase since June of 2021. And we're talking about annual increases. I always like to highlight, we're comparing to the year prior. 2023 was a very difficult year, as was 2022, as we saw interest rates start to creep up and we saw inventory to start to tighten. So there wasn't a lot of volume and a lot of transactions. So even though that shows, hey, good, strong number there, we're comparing to a very lackluster year, especially looking back at 2023. The median existing home sales price in the country, and again, the median is the most commonly occurring number, not an average, because the average could throw off the calculus because of the outliers on the top end and the bottom end. So this is the sales price that most commonly occurred throughout the country, and that was at $404,400. That marked a 6% appreciation of home value comparing December 2023 to December 2024. So that is where the year ended off with property price appreciation when we look at it through that time horizon. Despite how strong the fourth quarter was for real estate growth and real estate sales, the 2024 existing home sales came in at 4.06 million units, and that is the lowest level since 1995. I'm going to say that again. The amount of existing home sales in 2024 at 4.06 million was the lowest since 1995. If we go back to 1995, real brief history review, there was the savings and loans crisis that happened in the early 90s. So there was something functioning in the mortgage market that created some, well, I'll just say resistance and obstacles when it came to purchasing homes. And that was a domino effect that wound up occurring further into the decade of the 1990s. Where we are right now is a different situation. Lending requirements have not changed tremendously since Dodd-Frank and the major overhaul of the industry. So this is a situation that's more precipitated by a severe lack of inventory. So we're going to see how this plays out as we're starting out the new year. If 2025 is going to be a copy-paste of 2024 with the higher rate environment and nothing that is going to tangibly get prospective sellers off of the fence to create more inventory, we can expect much of the same here in 2025, which is the picture that's currently being painted by most accounts right now. Now we're going to focus in on the Northeast region. I'm situated in Totowa, New Jersey, so I'm going to talk about the whole Northeast, and then we'll get a little bit more granular into New Jersey. But overall, here in the Northeast, sales grew by 3.9% from November to an annualized rate of 530,000 units sold in December. There was a 10.4% year-over-year growth, which was the highest among all the regions in the U.S. The median price in the Northeast came in at $478,900. That's up 11.8% year-over-year, which is also the highest among all the regions. So now let's compare that to the national number we looked at. That's nearly 5% more in property price appreciation right here in the Northeast compared to the average median across the whole country. Why do you think maybe we saw such strong year-over-year growth? The inventory was extremely difficult here in the Northeast. It's a highly competitive and desirable market. With the current circumstances, with inventory remaining low, it's going to continue to push up those prices. So think about it. Here in the Northeast, annual property appreciation, December to December, 23 to 24, almost 12%. That is a lot of equity that's been built. So if you're currently a homeowner, you're sitting on quite a bit more equity than even you were at the start of the year. And if you've been that homeowner since before the pandemic, you are sitting on a lot of home equity currently. Northeastern home sales increased to 510,000 from 470,000 in the previous month, and up also from 480,000 from a year ago. So quite a bit more volume when we compare year over year. Not a ton, but making progress. And honestly, at this point, incremental progress is to be celebrated, that we start to see a little bit more activity. Getting into New Jersey, there's not a ton of New Jersey-specific information provided by the National Association of Realtors, but what we can infer from this information is that the Northeast region is pretty representative of New Jersey, and that property price appreciation is pretty applicable here in this market area, particularly in North Jersey, closer to New York, commuter towns, because the inventory is so low and the buyer demand, and we talk about it almost every month when we review the National Association of Realtors existing home sales data. buyer demand is only increasing. It's not being satisfied by the current inventory levels, and it's just increasing. So let's talk about the inventory nationally now. Nationally, we have 3.3 months of supply. That's down from the 3.8 months of supply in November, but also up from the 3.1 months of supply that we had in December of 2023. So a mixed picture we're getting here. Improvement year over year from December, but the trend has dipped a little bit compared to where we were going as we were heading into December to finish out the year. The balanced market. So if you are trying to see a balanced market in real estate, that looks like 4.5 months to 6 months worth of supply. So we're still pretty short of that for a balanced and healthy market. And the longer term exposure we have to this tighter inventory level, the more buyer demand will get pent up over time. So something tangibly needs to happen here, or it's just going to be more of the same, and it will be people's personal finances and personal budgets that dictate if and when they're going to sell their home. And it's really going to continue to be a needs-based market as we head into the year. People who have the need to downsize, people who have the need to move because of family growth or other reasons like that, but they are sitting on a lot of equity. So if you do need to move because you're starting to bust at the seams in the home that you're in, well, maybe they're going to renovate the home because we saw, like I said, Northeast region, almost 12% property appreciation. There's that much growth in the sales numbers, which equates to equity growth for those current homeowners. So there's a couple different ways that happens, but for those who sell, that will be something that can help stimulate. And there's quite obviously a ton of demand for real estate due to the longer term exposure we've had to these super low inventory levels. Now for our fun fact segment. This is something really cool because we're talking about the sales data, right? We've been talking about where things are going with real estate as we're starting out the year and rounded out 2024. Here's the fun fact. 90% of the world's millionaires became wealthy through real estate. It's a recent study. 90% of the world's millionaires reach their fortunes through real estate. So bear that in mind. As we're hearing here, there's a lot of equity that's being grown due to the lower inventory, and it looks like the fundamentals are there to keep that equity intact. Anything can happen. There's things that can happen that come out of left field. But if you're wondering if real estate is a worthwhile investment, the answer is yes, absolutely. And your time horizon, just like if you're to invest in the markets, in the stock market, your time horizon is what is going to dictate what is going to make sense for you and your financial goals. For today's Did You Know segment, this is going to be a shout out to a number of clients that I've been assisting with over the past week because it came up in conversation so much. I've been assisting a couple clients, one in particular, but they decided to maybe start pivoting to looking from single-family homes here in North Jersey to condos. And there's quite a few implications for condos. So for today's Did You Know segment, I am going to do a deep dive on the implications of purchasing a condo and what effects that has on your mortgage process and some very important things to be aware of. So first and foremost, purchasing a condo is categorically different than purchasing a single-family home, mainly due to the fact that the condo complex and the homeowners association requires review by the lender. And there are particular guidelines that we need to follow in order to ensure we can do the financing for that property that is located in a condo complex. So I'm going to actually use the acronym here. I like to avoid it, but homeowners association is HOA. So we will review the HOA to determine the HOA's financial health, insurance policies, making sure there's proper coverages, and reserves. We look at the budget for the condo. We also will have an appraiser go out there to appraise the property. There are appraisal waivers available. If they are available, if that condo was sold anywhere between the last 10 to 12 years or so, and you have the proper qualifications as a borrower, we may not need to have an appraisal performed. But let's just assume you need to have an appraisal performed on that property as well, which appraises just that unit. Now we're going to talk about the Fannie Mae and Freddie Mac guidelines. Fannie Mae and Freddie Mac set forth the guidelines for lending on conventional loans. So we're going to talk specifically now about conventional loan financing. First, Fannie Mae will not allow more than 20% of the units in a condo complex to be owned by one single individual or investors. And that applies to projects with 21 or more units. If it's 20 units or less, there's a little bit of a different way that we look at that. But if you're purchasing a condo in a larger complex, 21 units or more, this is applicable. For Freddie Mac, though, it allows for 25% of the units to be owned by one single individual or investor, or at least up to 25%. So there's a tangible difference. Either way, you can get a conventional loan. It's just about knowing which one. That's where your trusted mortgage professional comes in to know these guidelines and also determine which loan program is going to be the most appropriate within the conventional confines. Reserve requirements. Condo associations must have at least a 10% of their budget. So when they have their budget for the whole year of their outlay of expenditures, 10% of that needs to be in reserves for most loans to qualify. So Fannie Mae and Freddie Mac need to see a healthy amount of reserves. The project eligibility, that's something that the lender determines through reviewing the finances, reviewing the structural stability of the entire condo complex where the unit's being purchased. So that's when we're going to drill into the bylaws of the HOA. We're going to drill into the finances, the budget, and the reserves, and the insurance. We're going to take a look at the insurance policy to make sure that there's proper coverage and what that coverage dictates for the implications for the homeowner. Florida condos is where we need to really talk about this now. A lot of these guidelines had changed because of a higher sensitivity now to condos for lending purposes because of the Surfside condo complex collapse that occurred. That kind of threw up a red flag and was the impetus for a higher level of review and looking at more detailed information for condos to avoid that situation and to ensure that we can mitigate that from happening again. That also has created some more requirements for the condo complexes themselves to have proper inspections, particularly structural inspections, to ensure the safety and soundness of the structures that people will be living in. So those guidelines came out in 2021 in response to the Surfside collapse. Fannie Mae introduced new guidelines in 2022 that elevated the level of scrutiny for financials and the bylaws and the whole condo review process. Also, the reserve funding, that is something now that needed to be adopted by condo associations due to that situation that happened in Florida, so that if there is anything structural that needs to be taken care of, there's something that is in place to protect and mitigate that problem. Inspection requirements, sometimes we will have the requirement to have reserve studies performed and to verify that the condo's condition is suitable and that the capital needs are meeting the condition requirements for that condo. And there's also now an appeal process. So if at the front end, the condo, we will send out a questionnaire. And this is how the rubber meets road for this. We send out a questionnaire to the condo association for them to complete, so we can get all the information that's required, and that will point us in the direction of what further information we may need to get or further documentation we may need to have provided to us to make a determination on the eligibility of the financing for that condo complex. Freddie Mac has introduced a formal appeal process. In the event that those things don't line up, there may be suitable explanations. So that is something to bear in mind with condos as well. It's not the end-all be-all. We're just talking about conventional loans. If we look at FHA loans, FHA has a condo database that this approval process I'm talking about occurs outside of a buyer's transaction. The condo complex themselves goes through an FHA approval process where the FHA reviews everything, the Federal Housing Administration, and then they issue an approval for that condo complex for a prescribed amount of time, and it's in a database that I have access to and that lenders have access to research and understand if that condo complex is viable for FHA financing. If it's not on that condo database, fret not. There's something called spot approvals, where we essentially would go through the same process, comparable process, I should say, that we do for conventional loans, but we're doing it for our FHA borrowers. That does take some time in both of these cases, but the FHA approval process could build in quite a bit more time to get that approval completed versus the conventional approval process. One of the differences that we have here at Rate that I need to highlight is that we do have a pretty robust condo database. So for me and any of my colleagues that are currently doing business and have closed loans in certain complexes, we have a database that I can refer to, which is amazing, and I can see if we already have approval for condos, which could help expedite and also provide prospective home buyers with more assurances as they're heading into placing offers, because I can let them know this condo complex is good to go. They're on the Fannie Mae approved list or the Freddie Mac approved list. Or I can see that we've done business there 2 months ago. We just closed a loan in that condo complex. You're going to be good to go. That approval is still in our system. We can do just a quick update on some documentation and verification that may be required, and then we're good to go. So that's a limited review is what that is called, and that can help expedite the timeline for closing. Another thing to mention here is assessments. When you're purchasing a condo, you're going to have a monthly HOA fee. That is a monthly fee you're paying to the homeowners association of the condo complex for purposes of services and maintenance that the condo complex provides to you as a unit owner. This could be snow removal, landscaping. If there's amenities like a clubhouse or a pool area, your monthly HOA goes toward those costs that the HOA has to pay. There is a possible additional cost in the event that the complex needs work or needs to perform capital improvements, replacing windows, redoing brick work, repointing the facade, things like this. And that assessment sometimes has a time period, so it won't be like your HOA fee. It's a separate fee that's still due monthly. But let's say you have a condo in New Jersey that you're purchasing and the HOA fee is $450 a month. But it has an assessment because windows need to be replaced on one side of the building. The condo association gets an estimate for that. Then they provide that estimate to the condo board, which is comprised of unit owners who've been elected by other unit owners to represent them for the management of the condo complex. And they make their determination on what they're going to do for that. And then they break it down. You say, okay, it's going to cost us $200,000, $300,000 to do this capital improvement. There's 150 units here. We're going to break that down. Maybe the condo association has the money in reserves and they just pass that cost directly down to their unit owners, or they may say they need to go and obtain lending so they can get money from a bank that they're repaying at an interest rate, and then that charge gets passed on to the unit owners by way of a special assessment. A special assessment will be however long maybe the financing is, or however long the association is comfortable with getting repayment. Unit owners may be able to pay that special assessment in one lump sum, or they can spread it out in monthly payments. So when you're buying a condo, we're going to be looking at that special assessment. If the payment is going to be required, then we're going to have to factor that in to your debt to income ratios. So it could provide an obstacle to you when qualifying and when purchasing a condo. Overall, it's very important to keep communication at a high, frequent level with your mortgage advisor so that you're aware of all of these things for the condo that you may be interested in purchasing. That is it from me today. I hope you found this information helpful and useful. I'm looking forward to reporting out next week and seeing what the market reaction is to the inflation data we're about to get this week, and also seeing what happens with mortgage rates as we continue forth through the year here. If you have questions or anything that you'd like me to cover on the show, or anything you'd like for me to deep dive into further, feel free to email me at peter.d'angelo@rate.com. Also, you can find my social links in the episode description below. Feel free to reach out to me on socials. Otherwise, I hope you all have a wonderful end to your week, a great weekend, and take good care.